Okay, let's start again. Welcome back to the second half of the Sixth London Business Summit. And this session is called Investing in the Region, Sharing Opportunities and Challenges. In fact, there are two sessions with the same name. And we're going to start with Alex Patelis, the Chief Economic Advisor to Prime Minister Kyriakos Mitsotakis. Please, do you want to say a few words and then we'll discuss?
Thank you very much, John, and thank you so much to the organizers of this conference for the very timely and honorable invitation. So let me just make some brief remarks. As everybody knows, this government was elected on a platform of doing reforms, and that's what it's been trying to do. Over 250 bills have passed through Parliament since the summer of 2019. A lot of work has been done in the financial sector. We would highlight, of course, the reduction in NPEs from over half the loan book of the banks to single-digit numbers this year. The bill for corporate governance that was mentioned in the previous panels, and of course, another very important bill that hasn't received enough attention, the reform of the Insolvency Framework with a new restructuring and bankruptcy process for private debt in Greece, something that helps very much both clean up the bad loan balance sheet, but also spurs entrepreneurship. So the reforms are continuing. COVID hit in early 2020. This did not stop the government, and I would say from an economic standpoint, Greece was able to shatter its pre-pandemic image. GDP in Greece returned to its pre-pandemic level already in 2021, and we're hoping that 22, despite everything that's going on, will show another year of strong growth. In that sense, that crisis, the pandemic crisis, was an opportunity to do some of the structural reforms on taxation that we always wanted to do. There has been, as you know, a reduction in the social security contributions, taxation of salaried employment, and also the elimination of the so-called solidarity income surcharge, but also a sharp reduction in taxation of capital, corporate income tax rate now down to 22%, dividend tax rate 5%, and there's a host of other tax incentives for people to relocate to Greece, least of which is not the if you do relocate to Greece, half your income is tax-free for 7 years. That's for the people in the audience of this room. But we have now the Russia invasion of Ukraine, which obviously creates new geopolitical uncertainty and in particular affects Greece primarily through higher commodity prices. Greece doesn't really trade much with Russia or the Ukraine, but the commodity price shock is global and it is going to be significant. Of course, as they say in the United States, when life gives you lemons, you make lemonade. So we have to make the best of what we can of the situation. But it will not stop our desire to reform. There are, for example, just now 2 very important bills that are being submitted to Parliament. One is to reform primary healthcare, and another one is to reform the unemployment benefit system in Greece, OAED, and also the skilling, reskilling, and upskilling of Greece. There are significant amounts of money, over €1 billion, that have been allocated through RRF, Greece 2.0, the Recovery and Resilience Plan of Greece. And the skilling system in Greece was long overdue a reform. We now have unemployment having fallen to 12%, which is obviously high by international standards, but it's much lower than the pre-crisis level, than the crisis high of 28%. And this is a new environment for the labor market in Greece, and skilling and reskilling becomes very important. Those are, I think I've used up my 3 to 4 minutes, and I'm very much looking forward to a conversation with John. Thank you.
Well, thank you very much for those introductory comments. Reform, you certainly have done quite a lot of reform by European standards. The return of inflation because of the commodity price, but even before the commodity price rise, associated also with energy prices, and the beginning of rising interest rates. These will be difficult for a country like Greece?
So this is going to be another global symmetric shock, not similar to the pandemic, but it's similar in the sense that it's global and it's symmetric. And we hope that Greece will be able to come through this with some of its, let's say, relative points shine through. And you mentioned interest rates. Greece's debt, government debt, has one of the longest durations on the planet, 20 years.
We heard from the finance minister.
And 1.4% average interest rate, which is pretty extraordinary. It's also extraordinary that those numbers didn't really change much during the pandemic. Private debt also is being restructured and is being dealt with. The inflation shock is more complicated. On the interest rates also, let's also add that the private sector remains underlevered, and there's a whole generation that never took out a mortgage. And this is still a huge structural opportunity in Greece, and one should juxtapose other countries where negative interest rates have been around forever. For example, in Denmark, people have had negative interest rate mortgages. So we have no doubt that the interest rate shock will be manageable in Greece. In terms of the commodity price and inflation shock, it's more complicated. Obviously, Greece during the crisis had long periods of deflation and, let's say, steady price levels. So a little bit of inflation in a country that has high nominal debt isn't necessarily a bad thing. And when you do your DSA this year, you'll find that the debt in real terms will be declining also because of inflation. Of course, we need to be careful that this does not feed through into an inflationary process similar to the one that we had in the 80s.
Yes.
But I would argue that with the spare capacity that Greece has, the product of this whole decade of a crisis, it's not going to be the first country where such problems appear.
Interesting. But just still on this public debt issue, I mean, it was very interesting to hear the point about how much of it is also at fixed rates, and the burden of servicing it is therefore relatively low. But it is still the case that you have the highest debt burden in the European Union. I mean, in the long run, is that not potentially still a problem for Greece?
In the long run, it's a problem if you cannot reduce it, and there's a denominator and there's the numerator. And so in this case, we're working on trend growth, increasing trend growth. And if you do these DSA calculations, you make a very small change to the underlying trend growth, and you have a very large impact. Many of the forecasts that people have are unduly pessimistic in our view. And actually, I would argue that COVID masked what is already an increase in Greece's trend growth. Otherwise, it's very difficult otherwise to explain how Greece ended up recovering its pre-pandemic GDP level earlier than other countries, given its high reliance on tourism, which was obviously hit during COVID.
And losing Russian tourists, Russian money, you can survive that?
It depends what figure you use.
Yes.
No, but it's something around 400 million or so. Income from tourism from Russia.
One of the other things that we are going to talk about again, but we have talked about already, is the energy of the Eastern Mediterranean. I mean, does that mean that you can look forward to a point where actually Greece benefits from higher energy prices because you have the potential to export quite a lot of gas eventually? At the moment, an energy price shock is bad for Greece, but is the balance of that going to change a little?
The balance will change over time in the sense that Greece today is a net energy importer, particularly of oil. And throughout the green transition, this is going to change as renewable energy sources are developed. And obviously, Greece has a lot of sun and a lot of wind. As these develop, we will hopefully become a net energy exporter. And the climate transition has significant economic and political repercussions that have not been widely appreciated. It will change the balance of power. Another thing that the government is working very hard on is to improve the storage facilities, but also the connectivity with the region. So we are in discussions with Egypt to develop connectivity there, with Saudi Arabia and with other countries, because one thing we have learned from the energy crisis is that you need not only more production, but you also need more storage and better connectivity to be able to handle temporary deviations between demand and supply.
And the region, the Eastern Mediterranean region, since we're discussing that, there are some quite troubled economies in this region. I'm thinking of places like Lebanon, Syria, but also now Turkey. Is that awkward? Is that problematic for Greece? I mean, you see exchange rates moving very sharply. The Turkish lira has devalued significantly in the last 12 months. That makes Turkey more of a competitor in some ways.
So it's not the role of an economic advisor to comment on other economies or an exchange rate. Actually, someone did ask me my forecast on the euro, but that's a different story. But I can sort of answer or address your question indirectly in two ways. The first is to point the obvious, that this is why we didn't want, in response to the same question that was made in the previous panel, one of the reasons we didn't want to leave the euro is precisely because you can end up with all kinds of destabilizing equilibria. But I would say also devaluation is a funny thing. It works until it doesn't. And there's a level beyond which you devalue your currency, and that just creates inflation and creates instability and uncertainty, and that actually becomes a detractor for investment. And I don't know if it's not my job to judge whether Turkey has reached that point or not. But devaluation doesn't necessarily mean that you gain competitiveness.
No, well, we have experience of that in this country several times in the past. Devaluation has sometimes helped, but quite often it doesn't seem to have done, and it didn't really help even after 2016.
But I would argue also that this is not primarily an issue of devaluation. It's a question of institutions, credibility, and stability. And the Euro project and the European Union project are not just an economic project, they're also a political project. And they create the framework in which the institutions of a country can withstand the shock. So Greece went through a decade of a crisis. We had unemployment reach nearly a third of the population. Yeah. This is the kind of stuff that Marx wrote about. And the protection that we got, the institutions have come out stronger than before. And I would argue that one of the selling points that we have as a country now is precisely that we withstood this strong crisis. And so this gives you extra comfort as an investor that a country that has been through the worst and has come through it is actually a safe country to invest in.
Interesting. I mean, the central banks of Lebanon and Turkey are not perhaps good examples of institutions that work well. I understand you're not going to comment on other countries, but I mean that is the advantage of the framework of the European Central Bank and the Bank of Greece.
And not just the central banks, the judicial system, the political system. Don't forget, Greece also went through populism. It went through what I would call political fragmentation, where there are many small political parties which create unstable coalition governments. These are phenomena that we are seeing in other countries in Europe and in the world, and Greece went through.
You pioneered this with Syriza to some extent.
I will quote Mark Mazao, as you know, has written a wonderful book about the Greek Revolution, arguing that Greece was at the forefront of other revolutions. So the country has in the past been a leading indicator of other countries. We can debate about why that's the case.
And I was also wanted to ask you about the negotiations with Brussels, since I believe you're heading to Brussels for another summit. I mean, there is obviously Greece, like Italy and indeed Cyprus, is benefiting a lot from the Resolution and Resilience Fund. There have been the beginnings of discussions, which I know your Prime Minister has also joined in, about another fund to help in the future. But as we were discussing in the earlier part of the meeting, not all the countries of the Eurozone are very enthusiastic about this idea, particularly not Finland, the Netherlands, probably not even Germany with Finance Minister Lindner. How do you see that panning out? I mean, do you think that having done it once, you have now established the principle that there should occasionally be borrowing at European level for the benefit of all?
Together with Minister Kyriakos, and we were honored to be part of the team that put together Greece's proposal, Greece 2.0, for the Recovery and Resilience Fund. Our focus is on implementing that plan, and if it's implemented properly, I'm sure things will go the right way. But in terms of the energy crisis, this isn't really our proposal. Our proposal at the moment, at the national level, that the Prime Minister brings to the table, he wrote a letter to Ursula and also tabled an op-ed piece that natural gas market is broken, and we are calling for regulation. We're calling for a price cap or limits to the daily fluctuation of gas prices and other such proposals. So there's going to be a heated debate in Brussels. Different countries have different opinions, as always, but we should not stray away from the fact that the European Union has responded quite quickly to the crisis in Ukraine, and I'm sure you will agree that it happened faster than what most people had expected and broke a lot of taboos, and I'm sure this will continue.
I'm looking to see if anybody wants to ask any questions from the audience as well. So if anybody has any questions or comments they'd like to make. Yes, at the back there.
Thank you, Maury. I'm Jonas Floriani from Axia. My question is, one of the big kind of milestone for this government and also a reward would be reaching investment grade, right? Pre-war, the expectation was that this could happen in the first half of 2023. I'm just wondering now from your expectation, the higher inflation, potential slowdown in GDP, and also changes in government financials could change that time frame? If yes, what are the levers that the government can pull to mitigate some of this negative, some of these headwinds?
Thank you. Look, the government can do its job, and that's what it has to do. And the rest, outside shocks are beyond the government's control, and ultimately might or might not work a particular way. I will remind you that Greece was upgraded twice during the pandemic, and I'm sure that if you had been told, you would have thought that that was highly unlikely. And I don't know why it got upgraded. I mean, we can, there are various reasons, but I would say the primary one is that the rating agencies judged that the government was serious about what it was doing. So the government just needs to continue down the same path. In terms of how the Russia-Ukraine crisis will affect the variables that the rating agencies monitor, I would argue that it's quite complicated. Debt to GDP depends on the numerator and the denominator, and we have potentially a higher growth rate in the nominal GDP. It's still not clear how much of a hit it'll be to real growth. But ultimately, the government has to continue to do reforms. The banks need to continue to clean up their bad loan book, and if we do that, and there needs to also be political stability, and if we do that, we have no doubt that we'll get investment grade in 2023.
2023, okay. One more question before we move on to the next panel, if there's anybody wants to ask another question. Yes, over here.
Hi, Vasilis Stefanopoulos from Mount Street Portfolio Advisors. Pre-pandemic, you had in the Greek banking system around 70 billion of NPEs. And around 40 to 45 billion of that was business, small, medium, and large businesses. That, and taking aside the pandemic, today that's much lower number officially on the bank's balance sheet. Mostly now that's guaranteed by the government through the senior tranches of the hubs. First of all, capital is not flowing into these businesses, because on their business balance sheet, the loans are still there. The judicial system still cannot process enough the enforcement that needs to go through. How do you expect to make any further adjustments to the judicial system, to the enforcement procedure, and are you happy with the rate of improvement into the business plans of Hercules project?
Thank you. I'm not sure I agree with your description of the events. A very important piece of legislation has been the Insolvency Framework, and we should not underestimate this. This was voted through, when was it? Summer of the previous year, 2020, but it's only being implemented now. And this is something that just takes time. But many businesses and individuals are seeing that that's being restructured as we speak. In terms of small and medium businesses, or businesses in general in Greece, I would highlight that deposits of enterprises are at an all-time high. All-time high, meaning they're higher than they were before the crisis. So it's very difficult to argue that the businesses are constrained by cash, or that they're somehow constrained. Obviously, that's true at the aggregate level, not at every individual level. And we are also seeing very strong demand for the RRF loans that Minister Kyriakos mentioned before. So I would say that there's sort of many things happening at the same time, but we're very happy with the way things have unfolded for the businesses in Greece, and we are very confident that private sector debt is manageable in Greece and will continue to be worked through and decline. Of course, I'm talking at the aggregate level. Obviously, there's going to be differences at various sectors or various companies.
Okay. Well, that's very interesting. Thank you very much.
Thank you very much
Alexis.
for your time. Thank you.